Hi, my name is Jason Green, and this is the first video in a series. Health insurance does not equal health service. And the first video, we're going to discuss insurance. I'm going to give a basic overview of insurance and how it works and what it's for, so that everyone understands what is going on with insurance, because there's a lot of misconceptions, and basically people don't really understand what insurance is for the most part. So we're going to start with a basic sentence to get the words that are common in insurance. A premium is to cover the cost of failure. My pen here is going nuts. In a given time span. Underline that. Failure cost premium. Okay. So in our first example, we're going to use a very basic example in that you have a dock. Okay, here's our dock. And you have lots of boats. You have lots of boats that are on the dock. You know, each person owns a boat. And so people take their boat out, you know, in a given year. You know, everybody takes their boat from the dock to the island. Alright, and so people are going here and they're coming back, and they're going here and they're coming back, and usually everything's just perfectly fine. But then sometimes there might be a storm, and there might be some lightning and some thunder, and you know, once in a while the storm is bad enough that one of the boats just it sinks, and so understanding what's happening here is that the odds of it sinking are, let's just say in a given year there are, you know, in this particular dock, in this particular island, there are 100 boats. Okay, making trips, you know, to the island, to the dock, and back and forth. And let's just say in a given year, one boat sinks. Yeah, so this is a basic example. The odds of your boat sinking are 1 in 100, so roughly 1%. And so, you know, if a boat sinks, let's say the boat costs $100. All right, so the person who bought the boat for $100 is now on the hook for another $100 to replace his boat. And you know, this could be pretty catastrophic, because maybe it was a person who inherited his boat, and you know, he doesn't have $100 to replace his boat, but he needs his boat because he goes back and forth between the dock and the island to deliver fish or carry people or whatever people are doing between the dock and the island on the mainland. And so an insurance company comes around, and by the way, this is actually the origin of insurance. The origin of insurance was with maritime traffic. The insurance of boat goods and boat cargo going from, let's say, Europe to America, for example. So an insurance company comes along and they say, well, look, okay, you know, there's only 1% chance of a crash. And you know, we have 100 boats here that are in our dock, and we have, you know, $100 chance or $100 cost for a boat, but there's only 1%. So, you know, in a given year, one of these 100 boats are going to crash. And so what they do is they come along and they say to each of the boat owners, you know, you can pay us a little bit of money and we're going to cover you against the cost of the boat sinking if in the rare event your boat were to sink. So they come in and they charge what is known as a premium. And so in our example, you know, we'll say the premium is $1.05. So each boat owner has to pay $1.05, and so the insurance company is able to get 100 boats signed up, all 100 boats, and so they collect $105 in a given year. Now, okay, let's say a year goes through, and one of the boats does in fact crash, and so they have to dole out $100. And so, you know, they dole out the $100, and they're left with $5 profit. Okay, that's fine. But you know, all the boat owners are happy because they only had to pay $1 to insure against the risk, and they, you know, they have peace of mind now. They know that if they're out there in the storm and their boat crashes, well, they're covered by the insurance. So a premium is to cover the cost of failure in a given time span. So in our example with the boats, the time span is a year. Okay, the failure is sinking. The cost of the sinking is $100, and the premium to cover that cost is $1.05, which is basically, if you want to understand how premium comes together, it's by looking at the risk, and our risk is 1 in 100. Now, obviously, it's much more complicated when you start factoring all these different things in, but our example is very simple. It's just a very basic example of insurance and how insurance works. And basically, if you should understand anything from this video, it's that insurance is designed to cover against something that is unlikely to occur. Unlikely to occur. Now, obviously each person, there's 100 of them, they're driving their little boats around. It's unlikely that they're going to get into the storm where it sinks their boat. And so that's an unlikely event. Now, obviously, the odds of them sinking is probably a lot less than 1 in 100. But that's good for this story. And that concludes our first video on insurance.